Hey, good morning, everyone. Marty Mazzora here, 3rd of December 2019, Tuesday. 2 points I want to make this morning. First one is the chart in front of you, the daily S&P 500. We've been for literally months and months pointing to upward sloping wedge patterns, divergences in momentum, lately overbought conditions, not anymore. As you can see, the market falling. And I've also suggested that these things in and of themselves are not sell signals, that you needed a break below trend lines. Well, you're getting that, and it is impulsive. Let me zero in a little bit. So we had this trend line. We broke down, and I said, we're back testing it. Let's go ahead and create another trend line, benefit of the doubt if you want to call it that. That's the dotted line. Broke down below that yesterday and gapped down today. So that is aggressive selling. That would be enough for a trader to go ahead and short this market and to bet on something bigger to the downside. Of course, as I keep talking about, we live in unusual times, and we now have the power of a Twitter account and a White House that is very quick to make comments, as is China. This is hurting China as well, and I've noticed of late that they seem very willing, literally just to put out rhetoric that really is designed to bolster their equity market as well. So both sides have, I think, big political risk to come to some agreement. This morning, though, the president said he may want to wait till after the election. Doesn't seem to be going so well in Europe, the two-day meeting that they're having so far. He and Macron from France are certainly butting heads. I thought it was interesting last night after a couple of days, in Dow terms, 400 points Friday and Monday, which really is utterly nothing when you consider how far we've gone here of late. But that's the kind of move that typically elicits, some kind of commentary to try to reverse it. Instead, yesterday after the close, Rob Lighthizer, the chief trade representative for the U.S., said we're going to slap, I think, tariffs on 24 billion of French goods. Yesterday morning, the president tweeted that we're going to tariff Brazilian and Argentinian steel and so on. So yes, we're at all-time highs. Yes, we've had a really impressive move. Yes, when this has happened in the past, we tend to get belligerent commentary on trade, and it tends to bring the market down a bit. So folks, here's my point. We can get into the charts. I can show you some of the indicators that I showed you last week that said this was just getting very dangerous, ripe for a fall. I said that once the bulls, if you recall, they're all loaded up on one side of the boat. Just watch what happens when their toes get a little wet in terms of them screaming to the other side. Relatively low short interest, super low VIX. All these things that just say, wow, you get a little catalyst, this market's going to come down a bunch. But yesterday I said it would be crazy not to expect, a tweet or a comment from, say, Larry Kudlow, by Friday perhaps. I saw one commentator comment that that's going to happen, before the market closes this week. Kudlow is going to come out and say we're really close to a trade deal and so forth. And I've said for months now, you wonder how long the market's going to continue to, want to buy that news until we get something concrete. But folks, let me just make this point. Whether, it's trade war on, trade war off, market at new all-time highs, the price action of stocks, even these technicals that, that tell stories in and of themselves, that's not why we become defensive. That's not why we're hedging. It's not about the price action. It does say something. I do watch these things. The technicals have continued to paint a cautious picture. But in the grander scheme of things, think about it. Back in December of last year, when this market was falling apart, I just capture the tail end of this. It started way, way higher. This was essentially intraday. It was a 20% decline. We never got cautious in here. We stayed sanguine the whole time. I was showing you charts and talking about this being a steep correction within the context of an ongoing expansion and an ongoing bull market, that we would likely come out of it and make new all-time highs, which was precisely what happened. Ironically, up in here, as you'll recall, I was showing charts and things saying I really expect this thing to come melting down. It never did. Back right about here, I was expecting this to come bouncing back. It didn't for, another several weeks before it ultimately did. Does this mean that, I was cautious in here and it didn't fall apart until maybe several more weeks? I don't know. I do still believe that the market is hanging in there. Traders are hanging in there pending a phase one trade deal with China. So this big drop, sure, we could break through some technical levels and there could be a wave of selling, and that could be it. That could be the beginning of the next big correction or the next big bear market. But I can tell you along the way, there's going to be intense effort to reverse it with trade meetings, phone calls, what have you, that we're almost there. My big question is when we get there to a phase one deal, and that's probably all there is. If that happens, bigger ag purchases and so forth, China making some promises, probably the rolling back of some tariffs. With in regard to that, in 12 days, tariffs are supposed to be increased on China. If this continues, folks, that ain't going to happen. We will find an excuse not to raise those tariffs. So the market is really dictating what the White House does at this point, I think, or it will if it gets much lower. Sadly, it is utterly dictating the actions of the Fed. The Fed is all in on the wealth effect. People right now, their net worth for the average consumer is higher as it relates to their discretionary income than it's been in history. Last time it was close to this high was right before the last two peaks, before the big, bad, ugly bear markets. There's lots of statistics that are concerning about that. So I think the Fed knows that they've got to, unfortunately, continue to boost asset prices if they can. They also know that they're continuing to inflate a bubble with the hope that the underlying fundamentals catch up to it. That remains to be seen, but folks, just bear with me on this. That is just not a narrative that you want to be invested in nakedly, for lack of a better term, or without some sort of hedge. So clients, you're either hedged or we cut your equity exposure if you just have a small account. And we're going to stay that way until things, get better. We are modeling, working feverishly on our next core allocation, and it's going to be different. There's no question. We're going to have to be more diversified. We're going to have to be more tactical. We are bringing currencies into the mix. It's time to do that. We're going to be adding gold, which we haven't done in a long time. It was like the late 90s, I think, last time we really actively had gold in portfolios. And I think it's time to do that. And in fact, as we're modeling that and back testing it, makes a lot of sense. In fact, today, believe it or not, the market is falling apart, and a third of the positions in our what it looks like is going to be our new core allocation are actually up, and that's the way it's supposed to work. So we're going to have a much less correlated mix of assets than we've had. We've been very correlated to a bull market the last few years. We are going to be correlated or allocated in a way that takes advantage of the market if it continues to bull higher, if you will. But we're going to have some assets in there that can do well in either scenario, a bull or a bear market. And then we're going to have some hedge going on. Right now, it's going to look a little different than the hedge we have on today. There may be a net cost to this one. We'll see. We're going to allow for more upside next year, if indeed we do have more upside than the current hedges allow. But we're still working out those details, so you'll know when we have that finalized. Right now, we are in the kind of the tweaking stage, and I'm doing a lot of deep research on each position and back testing and just making sure that's what we want to do. And then we're going to stay nimble. Certainly, we're going to be wrong on some of these individual positions, and we want to be in a position to be able to quickly move out of those positions and somewhere else when we realize that we were indeed wrong. I can keep rambling, but let me just run a few things at you and let you get on with your day. So, folks, it's not again, it's not tweets, it's not it's not rhetoric. It's this. Here we are back in July, right? July, August, turning red in our index. This has us cautious. History suggests that's justified, right? Back in here, as I showed you yesterday when we turned red, market rallied another 17% to the peak before it rolled over 51%. Right in here, we turned red. Market rallied 15% to the peak before we rolled over. Back in here, we turned red. Market's up 10% or so from the day we turned red. And went green again, red again, and so forth. But folks, these are reasons to be cautious. This is why we weren't back here. This is that correction last year, and we stayed sanguine again. So it's not about the price action. It does tell us things, but ultimately it's underlying conditions that are going to dictate where prices go in the longer term scheme of things. So in essence, folks, it's this. ISM manufacturing again ticked down here yesterday. Wednesday, we're going to get the services. Very important. These are surveys of purchasing managers all over the country. You can see this is, last time we had this, we had a 16% correction in stocks. Here we had almost a 20% correction in stocks. And here we had a 57% bear market. Here we had a 51% bear market. We didn't even get services into below zero back in here, but we finally did here. This rolls over. That's going to be a very ominous sign. It's ominous enough as it is, of course. It's of course it's industrial production. I mean, if that isn't an ugly looking chart, you tell me what is. And here's how it looks. Again, we've done this before, but here's how it looks, during recessions, right? And leading to recessions. Here's how it looks right now. So folks, again, it's the industrial stuff, as I've shown you a million times, that rolls over first before the consumer rolls over. Doesn't mean that this isn't going to come back. Look here, 2015-16, we didn't have our recession. We had a pretty strong correction, but we came out of it. We could come out of it here again. Thing is, we were still in the green in our index back here, and that told us that odds favored this. Right now, we're in the red, which tells us odds favor this, albeit slightly. I'm not making that call. I'm just telling you, odds are greater that it's this than they've been at any time during this longest expansion ever. So folks, there are another couple dozen charts in various areas, commercial and industrial loans, rail traffic, the freight indexes, and so forth, that look very much like this, that are concerning. There's also competing charts that are green that offset, the majority of those. We have a net macro score, meaning when we take the positives and minus the negatives or vice versa, of a -7, which makes for an index score of -8.14. 29% of the indicators are positive, 37% are negative, 34 are neutral, which means those can go in either way. So we're not there yet. We're not here yet. But I'll say it one last time, at least this morning. We are closer to this, given general conditions, than we've been throughout this whole time. I don't know about you, but I personally, as an investor, do not want my portfolio exposed to that kind of risk the way I had it exposed to the market throughout this whole bull market. And if you pay me or pay us to manage your money, we hope you'll be patient with us, because while this may turn out to be, from a net return perspective, a mistake versus hanging in there, it won't be from a net risk return perspective. And that's all I can promise, folks, is that we invest your money as responsibly and thoughtfully as you can imagine, which means willing to miss out on gains when the market is rocketing higher against weakening fundamentals. Otherwise, we just buy and hold stocks and go golfing every afternoon. That's not what we're doing. We have to take these things seriously. If we bounce back and the data improves, we'll lessen our hedging, we'll lessen our defenses, positioning, and we'll get more aggressive. That's just not where we are right now. And by the way, speaking of working on your behalf, one of the new things we've done just to deepen our research is we now have created 18 additional, we'll call them mini PWA indexes or general conditions indexes. Only mini because they don't, each one does not include anywhere near the 87 data points that the PWA index does. But what we're doing now is we are scoring the macro for the Eurozone, China, India, Mexico, Australia, Russia, Singapore, South Africa, Brazil, South Korea, Japan, Canada, Germany, Italy, France, and the UK. Just to get a feel, we are in a global economy, like it or not. And so we really want to track where the momentum is waning, where it's growing, and so forth. Also, as I've suggested, we're going to be much more nimble and tactical in our allocation. So we absolutely are going to be looking, as I said, at currencies, and there's a number of different currencies within those names I just mentioned, and individual country ETFs. We want to be where it makes sense, and we want to avoid where it doesn't. Just buying the International Index Fund, which we'll probably own some of, or the Emerging Market Index Fund like we have in the past, that feels good because it's diversified. But folks, it's not necessarily safer. If you pick up areas or regions that just do not make any fundamental sense because of existing governments and regimes and populism and what have you, it makes no sense to buy an index that's loaded up with that area. China right now, for example, while some people are optimistic on China, we've done a very deep dive the last couple of months on China, and quite frankly, I'm not. China has huge underlying structural and debt problems that are going to be very, very difficult to work their way out of. They can probably exert more top-down control because they're a communist nation. They may be able to avert some cataclysm like another 2008. They may not, but their debt picture is worse than it was then, frankly. And they've just got structural issues, and they're starting to do back to the old way of doing things in kind of a desperate stimulus measure. Having said that, I will say to their credit, they are allowing defaults. We are seeing China bond defaults almost daily now, and we haven't seen that. Now, on one end, people will tell you that's scary. On the other, I'd say it's kind of good that they're allowing it to happen. The emerging markets ETFs are just loaded up, with China, the main ones. We'll own some of that, but very little. We want to own more of the other countries. So anyway, folks, I have rambled way further than I intended when I started talking this morning. I'm just going to leave it there. We'll keep you posted, of course, regularly. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.